Good day, class. Our lesson for today is Internal Auditing and Operations Auditing Overview. So what is internal auditing? According to the IIA, the definition of internal auditing states the fundamental purpose, nature, and scope of internal auditing itself. So internal auditing is an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. It helps an organization accomplish its objectives by bringing a systematic, disciplined approach to evaluate and improve the effectiveness of risk management, control, and governance processes. So, the definition reflects a modern view of the profession and positions auditors in such a way that they can provide much more valuable assistance to their organizations. The definition of internal auditing contains some key language that is important to note. First is independence. This has to do primarily with the position of internal audit within the organization's hierarchy. So furthermore, internal audit should not be under the control of those they audit. Next is objectivity. It is related to the auditor's frame of mind and their ability to examine documents, processes, and programs without a bias, without an agenda, and with no other motive than to find the truth and communicate it accurately and promptly. Next is assurance. It relates to the auditor's ability to give confidence and make statements regarding the condition of matters within the organization. It is considered a synonym to compliance, as has been the traditional focus of internal auditors for millennia. Next is sustainability. The reports can be issued in accordance with the Global Reporting Initiative guidelines or another standard. So although it requires a great deal of work, but the report indicates that the financial and social advantages outweigh the costs. So that's for sustainability. Next is consulting. It is giving advice to management and the board and engaging activities that helps the organization resolve nagging business issues. And consulting also relates to the way auditors do their work, suggesting that the traditional mindset and role of the auditor as the corporate cop is being redefined and explained by a more business-minded professional whose goal is to be respected more so than being feared. And now designed to add value. If you ask a gathering of internal auditors if they add value in their organizations, they unanimously raise their hands in agreement. One of the goals is to show adding value can be achieved and convincingly. Another keynote is to improve an organization's operations. So it is a very interesting statement because many auditors see their role as that of checking things and verifying the accuracy of various items and activities within the organization. Next, help an organization accomplish its objectives. Many auditors practice what has been commonly referred to as controls-based auditing. In essence, they look for the controls within the process or program of the review, then check them to see if they are present and operating as expected. So by focusing on this, the internal auditors can add value and the possibilities are almost endless. And internal auditing brings a systematic, disciplined approach. So there's refers to the approach followed when performing the work. It is encapsulated in the standards, the practice guides, and practice advisories, which provide a great deal of guidance on how to plan, execute, and communicate the results of the work done. So our methodology is quite extensive and it provides enough direction and flexibility as a framework to examine virtually any aspect of an organization's operations. Then to evaluate and improve the effectiveness, which is, I guess, the main key of internal auditing. So our role as auditors goes beyond evaluating business dynamics and writing reports that merely list the problems identified. But the definition indicates that we evaluate, but also help to improve the organization's ability to achieve the goals and objectives related to, like risk management, the control, and governance processes. So what is internal audit? Internal audit is a department or an organization of people within a company that is tasked with providing unbiased, independent reviews of systems, business organizations, and processes. Its role is to provide senior leaders and governing bodies of an organization an objective source of information regarding the organization's risk, control environment, operational effectiveness, and compliance with applicable laws and regulations. The internal audit may be used to assess an organization's performance for the execution of a process against a number of standards, policies, metrics, or regulations. And the aim of internal audits is to identify weaknesses within the organization's processes and control environment internally, so that they can be fixed as quickly as possible to prevent harm to the organization or its stakeholders. Let's take a look at the objectives of internal audit. So, one of the main objectives of an internal audit is to keep stringent control over all activities of an organization. So, this is proper control. The management needs to assure that financial records are authentic and operations are effective and efficient. So the internal audit helps establish both. Next is review of business. So the purpose of internal audit is to keep a check on the financial and operational aspects of the business. So as the current financial year is ongoing, internal audit can point out mistakes, weak points, strengths of the business, and will allow an ongoing review instead of waiting till year end. Another objective is it keeps a check on errors. So in a financial audit, the auditor will be able to determine if any mistakes were made in the financial records. But this happens only at the end of the financial year. Another is detection of fraud. So in case the company has an internal audit in place, the detection of fraud becomes much easier, and there's a year-round check on employees. Another one is asset protection. So in the process of internal audit, there is always evaluation and verification of assets, like physical verification of the ownership and possession of the asset. So it is the role of the internal audit to protect all business assets. Another is perfect accounting system. Although we don't have that word as to perfect, but we aim to have that kind of perfect one. So an internal audit keeps a very close check on the accounting system of an organization. It checks everything from the vouchers to the authority of transactions and to mathematical accuracy. So all entries are verified against documents and other proofs, so that chances of mistakes and frauds are greatly reduced. So those are objectives of internal audit. Internal audit versus external audit. So what's the difference between the two? As you can see on the table, we distinguished internal audit and external audit into some categories. So first, who performs internal audit? So internal auditors do, and mostly these are employees of the company, while external audit are typically members of the CPA firm. So those are licensed auditors. Next is the audit's reportorial. So internal audit reports to the BOD, the Board of Directors, and the members of the management, while external audit reports to the shareholders and members outside of the company. Internal audit as to coverage. So internal controls related to governance, risk management, and process improvement, while external audit focuses on financial reports and internal controls related to financial reporting. So why do we perform internal audit? It is to assess and improve the effectiveness of governance, risk management, and control over critical processes, and also to provide the board and management with the information and assurance related to their duties. While external audit is to validate or provide reasonable assurance the material accuracy of financial reports from the organization to its stakeholders, and of course to add credibility and reliability to financial reports from the organization to its stakeholders by giving opinion on the report. So internal audit reports at any frequency designated by the board, designated by the management. Some reports monthly, some may report weekly, so it depends on the management or even the department's typical reporting period, while external audit is done annually. And then for the responsibility for improvement, of course the internal audit, its purpose is for the improvement, but it is done by advising, coaching, and facilitating in order to not undermine the responsibility of management. So more on sharing the weak points, the lapses on the controls, and then informs the management, suggest corrected controls or any actions needed to be done to prevent harm to the company. While for external audit, there is no responsibility for improvement as it focuses mainly on financial reports, but however, there's a duty to report problems. As a continuation, so as to scope of work, internal audit is focused on organizational operations, while external audit is on fiscal financial records. Internal audit focuses on enhancing and protecting organizational value, while external audit aims to present fairly the financial statements. As to review and testing level, internal audit is much lower, while external audit is higher. on the range of risk. Internal audit is broad as it focuses on the operations, and the operations is so wide. Different businesses with different departments, different flaws. While external audit has narrow range of risks as it focuses only on the financial data. So, internal audit as a time horizon, it is current and forward-looking, of course, while external audit is based on historical data. As to issue description, internal audit raises both non-quantifiable and quantifiable issues. External audit, since it is on financial data, it is quantifiable. As to materiality, internal audit focuses on efficiency, customer service, continuity, like effectiveness, productivity, and the like related to operations, while external audit is only on financial reporting. As to outputs, internal audit gives recommendations, while external audit gives opinions. And as to standards, internal audit adheres to the IIE's International Standards for the Professional Practice of Internal Auditing, while for external audit, it follows the GAAP, which is the Generally Accepted Accounting Principles, and the GAAS, Generally Accepted Auditing Standards. So those are the distinctions of internal audit and external audit. The internal audit has its advantages. First is it facilitates more effective management of the organization. The internal auditor will be able to point out any weaknesses of the organization, may it be in the operations or the internal controls, and the management can use these insights to better the chances of achieving their goals. Another is ongoing review. So the process of internal audit gives the organization a unique opportunity to conduct a review of the performances in the ongoing year itself. Another advantage is it improves staff performances. Why? Because the staff remains alert and active. The employees had a fear of their mistakes being caught by the internal auditor almost immediately. Thus, this will improve the efficiency and performance of employees. They will not attempt to defraud the company for same reasons, of course. And also, internal audit is a good moral booster for honest employees. Next is ensures optimum use of resources. So it is a tool to promote the optimization of resources, to point out the areas in which resources are being underutilized or wasted. So it will be corrected, and it will help control the costs and expenses of the company. And last on the list as presented is the division of work. So internal audit helps promote division of labor, checking and observing the activities of departments and employees. So sometimes there is a reshuffle of the workloads to prevent fraud and to check on the controls. Next, internal audit also has limitations. Like every good thing has a flip side. So there are still concerns. So let's take a look. The first one is shortage of qualified staff. So the work of the internal audit requires years of study and experience. So an inexperienced auditor can cause more damage than good. So usually the company will find it somewhat difficult to find enough qualified staff members for the process of an internal audit. Next is time lag. So what is this? The time lag is between accounting and auditing. Internal audit cannot begin till the accounting is complete. accounting and auditing cannot be done simultaneously. So if the accounting is delayed, so as the internal audit. And last, ignorance of management. So unlike a statutory audit or the external audit, the findings of internal audit are not published or made available to all. So the findings are only forwarded to the management. Now, even if an internal audit report points out to the shortcomings of the company or the errors of financial statements, the management may not take corrective action and chose ignorance of such findings. Thus, there will be no benefit gained from internal audit. So those are the advantages and limitations of internal audit. As you can see on the illustration here, so the internal audit and external audit has common denominators. So as you see in the middle portion of the linked circles, so both provides assurance, both provides auditor's report, and both provides communication of issues in the financial process. So again, the comparisons of both can be seen on either sides. So internal audit is performed by an internal auditor, while an external audit is performed by independent accounting firms. Internal audit reports to the management of the company, while external audit reports to third parties. Internal audit assesses and improves internal controls, while external audit confirms that the company is following GAAs and as required by certain companies. Internal audit voluntarily scheduled by management, while external audit is generally involuntary. So those are the distinctions, the comparisons of the two types of audit. And now let's discuss operational auditing. So operational auditing is defined as a feature-oriented, systematic, and independent evaluation of organizational activities. Its financial data may be used, but the primary sources of evidence are the operational policies and achievements related to the organizational objectives. So internal controls and efficiencies may be evaluated during this type of review. Another definition is from the Business Dictionary, which is a review of how an organization's management and its operating procedures are functioning with respect to their effectiveness and efficiency in meeting stated objectives. For example, a business might perform an operational audit if its senior management has become convinced that operational improvements can be made and need to be identified. So this is done to benefit the organization's stakeholders who trust internal auditors to identify anomalies, to verify that resources are handled responsibly, and that the organization is structured and operating in ways that is likely to succeed. So that is the definition of operational auditing. So operational auditing can be likely similar to performance audit. So as you see, operational auditing is an audit on the use of resources to assess whether those resources are being used in the most efficient and effective ways to fulfill an organization's objectives. While the definition of performance audit, it is an audit of the management of an organization, program, or function to identify whether it is being carried out in an effective, efficient manner and whether management practices promote improvement. So, as you can see, there are common languages found on both definitions. So there is efficiency, effectivity. It focuses on the organization or management. Let's talk about auditing continuum. So as you see on the pyramid, we have the operational audit, then probity audit, ICT control audit, financial audit. Next is compliance audit and controls testing, and last on the bottom part is the ISO management system audit. So this auditing continuum is most likely represents the types of audits. To provide clear-cut definitions of the types of audit mentioned on the auditing continuum. So we have operational audit, probity audit, ICT, control audit, financial audit, compliance audit, controls testing, and ISO management system audit. So operational audit is an audit of the use of resources to assess whether those resources are being used in the most efficient and effective ways to fulfill an organization's objectives. While probity audit is an audit that ensures that the procurement process is conducted in a manner that is fair, impartial, accountable, and cost-effective. ICT control audit is an audit that evaluates if the controls to protect information technology assets ensure integrity and are aligned with the organizational goals and objectives. Next is financial audit, which is an independent objective evaluation of an organization's financial reports and financial reporting processes. Another is compliance audit, which is an audit engagement in which the goal is to determine whether an organization is adhering to the terms of a contract or certain rules and regulations. Next is controls testing. It is a type of audit examination on the internal control of an entity after they performed an understanding of internal control over financial reporting. And the last on the list is ISO management system audit that scrutinizes objective evidence to determine the suitability, conformity, and effectiveness of the elements of an organization's quality management system. Now let's tackle about financial auditing versus operational auditing. So based on the illustration, financial auditing is carried out with the intention of obtaining an independent opinion of a true and fair view on financial statements, while operational auditing is carried out to check whether the operations of the organization are being carried out effectively and efficiently. Financial auditing is carried out by external auditors, while operational auditing is carried out by internal auditors. Financial auditing has a standard format on its report, while operational auditing doesn't have one. Financial audit reports must be published publicly, while operational audit need not. Financial auditing professionals are performing financial audit, and those are the external auditors, not controlled by management. In operational audit, auditors performing such are employees of the entity and controlled by management. Here, let's distinguish financial versus compliance versus operational. So you can check out the differences based on the table as the objective, primary audience, the direction of audits, the audit basis, and examples of the three.